Oh, Sam is just commenting, when you make more than 30 to 40% profit, take the profit. Otherwise, I've seen it dry up and you land in a negative zone. And that's mainly for calls and positions along those lines. But I don't like to, we've talked about this before, you know, I trade the bull put credit spreads, usually 3 to 4 per cycle going 2 weeks out. And a popular management idea for bull put credit spreads, which I don't like, and I'm not saying it's a bad idea. We reviewed this a little while ago. But on a let's go to bull put credit spreads. So we did review last week, I believe it was. I can't remember the gentleman that asked the question, but we did review the 8 ways we would consider to manage a bull put credit spread or bear call credit spread with reversed ideas if the stock started to move against us. A popular theory that's out there, and I believe the gentleman even said it's said a lot, used a lot, discussed a lot, and advocated a lot by the Tasty Trade team. Very knowledgeable, very useful education they have. They're great people. But they advocate when you have a credit spread to look to close the position when you've made 50% of your expected profit. And Sam commented here that, you know, when you have a 30 to 40% gain, you might want to try to lock that in or close it out before it dries up on you. In my experience and the testing and trading to develop my technique over the last 4.5, 5 years for bull put credit spreads is that this doesn't work out for me long term. Closing early doesn't work out for me long term. The idea behind it, now let's talk about what we're doing here. If I sold to open, let's say we have a stock trading at 70, and I want a nice 2-week out, 10-day out bull put credit spread. And I see an opportunity to sell to open, let's say, a 67 strike, 2 weeks out in time, 10 days, 14 days out in time, and I get 85 cents for this. And at the same time, I can buy a 65 put, so that'd be down here. So I'm going to buy to open the 65 put, and let's say that cost me about 55 cents. So what am I going to get? I'm going to get a 30-cent net credit on a risk of $2, or in reality, it's a risk of 170. Now, the structure of the trade and the trading plan that I've developed is I'm looking for bull put spreads that have an 85% probability above of expiring worthless. Over the last 4.5 years, I've exceeded that target. It's about a little bit more than 87%. It's about 87.6% of the time the positions expire worthless. Okay, and on average, it's about a 14% return or so. And of course, the 14% return about 87% of the time, 87.6% of the time. And when I take a loss, it might be a 50% loss or so, 45, 50% loss. So on a 2-point spread, that'd be $1. And that happens the remaining 12.4% of the time. This gets me to my goals. Now, the 12% of the time that we have losses, those usually happen in the first 2 to 3 days. Remember, when you open a bull put credit spread, really any option strategy, you're essentially down from the beginning, just due to the slippage of the bid-ask spread. So when a bull put goes against you, you usually start off a little underwater, maybe a 5%, 6% loss. But if the stock starts to pull back, you never get a chance to close the profit at 50%. What does that mean? That means this 12.4% of the time over the last 4.5 years, I'm still losing an average of 45 to 50%. The idea behind closing a credit spread early when you have a 50% gain is that you'd hopefully move these numbers, that your 85% winners would move up to 90, 91, 92% winners. In my experience, that hasn't happened, because the ones that I win on are the ones that start winning within the first 2 to 3 days in that case. And if I cut off the gains early and only took a 6 or 7% profit on the position while still losing 50%, 12.4% of the time, That's not going to meet my goals because I didn't increase this because I'm still losing on those ones that go against me in the first couple of days. Okay. All that being said, I think, honestly, I'm comparing apples to oranges. I'm going to run through the numbers for you on the radioactive trading site. We're going to use that trade simulator tool to just run those numbers so you can see the examples. But I think I'm talking about apples and oranges. When I talk about a spread position, I'm referring to what I do with bull puts and occasionally bear calls when the market turns. I'm looking 10 to 14 days out in time, only 2 weeks out, deep out of the money bull put credit spreads, net credit of 20, 25, 30 cents, looking for around a 14, 15%, 12% return with an 85% probability. Oh, Tom says, what trades would match your criteria? Okay, well, I'd go to bull put credit spread, and I might do this on Monday, and I'll go into the search. Let's see here. And we've got the weekly bull put screen shown here. As you can see, we're going 8 to 17 days out in time. And what am I looking at here? Well, you've got Tesla, Norfolk Southern, Mongo, BlackRock, and here we're seeing the top 10. The top 5 are all 16, 17% returns with 85%, 91% probabilities. This is the list I choose from. This is what I look for. Yes, I'm automatically in the filters looking for the criteria that I want for the spread, technicals I want for the stock and fundamentals, and avoiding earnings between now and expiration. I don't want the surprise in a credit spread or iron condor. So that's typically what I do. Okay. Yes, and the reason I'm going 14 days out in time is because after extensive testing, that's what we found worked better. Works better than the 5-day out or 7-day out trading positions. They performed better over various market conditions over the last 4.5 years. So that's how we've structured this search, the default weekly screen. So this is the list that I would choose from right on Power Options if I'm going to open new positions on Monday with the Lulu 1 and TTD expiring worthless today. Now I had mentioned the numbers, okay, and every time I've run these numbers and I've done this testing for my position, let's do this first and then I want to go back to talk about why I just said I would think I was comparing apples to oranges and even to what Sam was saying as well. I'm sorry, I'm going to go to the resources link here at Radioactive Trading and we're going to click on the Trade Simulator tool. And let's say I was using $10,000 and about 33% of that $10,000 into each of the 1 or 2, 3 spreads I'd open, a third to each of those 3 spreads. And my target return I said is 14%. I know I'm going to lose 50% potentially in an unseen, unknown event like today if the stock falls and suddenly the bull put goes against me. But we're going to put this up at 87%, I'm sorry, 13%. Meaning that an 87% success rate, 14% when I'm right, 50% when I'm wrong. What did I just change? Okay. Oh, I changed the full value here. Let's put back 10,000. Okay. And let's just simulate those results. And down below, you see here at 82 and 18, I'm still at a 50% profit after 100 trades. That's well within my goals. And it's not bad of a drawdown either, about 16, 17%. Okay. And at one point, yes, it was more than double. I'm going to try to get just about, okay, let's use 86. No, I don't. I want to see a drawdown. Let's go to 85. I want to see some losers at the beginning. That's what I'm trying to do. 88's too high. 85. Let's leave it at, that's a real big drawdown. But possible. That is a potential drawdown. Okay. Long story short, this is flipping a coin 100 times. Heads, I make 14% when I'm right with a third of the investment. Tails, I lose 50% when I'm wrong on a third of the $10,000, $3,000 roughly. And if we're right 85% of the time, you see that we might see a drawdown with strings and win and losers over time because it is a leverage strategy. You have to expect that. But you have the profits for the potential, for high profits. That's the idea of leverage strategy. But again, and by experience, with the shorter term credit spread trades, 10 days out, 14 days out in time, if I lopped off the wins to 50% when I saw a 50% profit to 7%, I'm still losing 13% of the time at a tune of 50%. Oh, sorry, just had it there. And you see here, even with an 86% success rate, that's not working. Long term, it's not a successful plan. Because the trades that go against me and still get near that 49, 48, 50% loss when the sudden event happens, they happen right away. It never got to a 50% profit. It didn't help me increase this win ratio. So I'm not going to close out early. Now let's go back to power options. And I'm sorry, I'm just going to go back to the bull put credit spread. What Sam is referring to with closing at 30 to 40% profit on a long call or maybe a long straddle or hedging it versus what I'm talking about. And I believe versus what tastytrade teaches about closing the spread out when you have a 50% gain. The reason why I say I think it's apples to oranges is I'm talking about a shorter term credit where you're trying to get the goal of the full credit on the position. But yes, Sam, if I opened this Tesla spread on Monday and it had a 30% return because of the high premium, and in 5 days I could close it and get half of that 58 cents, which would still be a 15% return. That I would do. Definitely. Don't get me wrong, because 15% is my target. That I would do. What I think they're referring to is the alternative plan, an alternative way to do spreads. What am I doing here? I've got a 2.5 point spread, selling a 580 put, buying a 577.50 strike put for a net credit of 58 cents that has an 85% probability. I'm risking 192. So this one's not bad because it's a 30% return, but it's about a 4-to-1 risk-reward ratio. And a lot of times with these deeper in the money bull puts, I might be at 7-to-1 or 8-to-1. A lot of investors don't like that. And that's why I've spent all this time doing all this testing and developing this criteria to get the success rate I want and to be able to share it with you on power options so you can see, just the trades themselves without getting in depth into the whole trading plan. That's going to be coming out soon. But what a lot of educators, and I've seen this at tastytrade, but a lot of educators and a lot of options traders like to do is go further out in time. This would have been fantastic had we done this month ago, of course, a couple months ago. Maybe 35 to 40 days out in time. And to avoid this risk-reward ratio of an out-of-the-money put, which might be 7-to-1 or 8-to-1, they're going to look to do sort of an at or out-of-the-money bull call debit spread. Meaning, I might buy the 650 and sell the 660 on Tesla. So this is a debit spread. We're buying the deeper in the money strike, 650, and we're going to sell the 660 in this case. This probably isn't the best approach. This is going to look weird. Oh, it's all right. But this is about what we're looking for. It's a bullish strategy, but we're giving ourselves more time for the stock to move in our direction. We're out of the money, so we have a lower probability. But what do we have? We have a cost basis of $477.50 on a 10-point debit spread. So max return of 500. So what do we have? We have a greater than 1-to-1 risk-reward ratio. A lot of investors that seems to appeal to, because if I'm wrong, hey, I've done a proper structure, I only did a couple contracts, and this only represents 2% of my portfolio, but if I'm right, I'm 1-to-1. You just don't have the probability. Tesla still could continue up in 45 days above 660. I'm not saying it couldn't. I'm not saying I'm bearish on Tesla right now. I'm not making any recommendation. I'm not entering this trade. I'm just saying this is a structure that some investors appeal to for the lower risk reward that's 1-to-1 or 2-to-1 rather than 7-to-1 or 8-to-1 with the deep out of the money, high probability credit spread. And in this case, if Tesla goes up to 655 between the strike prices and we can close this position out and get $260 of profit, instead of expecting the full 10 points to get 523 back, but we can close it for 6 points and make 260. Okay, well maybe 630. The debit to close would be the credit to close would be 630. So we, I have about a 260 profit here. 50% of what I expected. I'm still taking that because it was still only a 2-to-1 risk reward ratio. That's what I think they're referring to. If I just bought the 650 call or the 640 call and it moved up and I've got a 30, 40, 50% gain, to close it out at that point rather than risk it pulling back down and risking 100% of what you invested. I don't think that when they're talking about, when tastytrade's talking about closing it at 50% or other options gurus, 50% profit, I don't think they're talking about a high probability short-term under 20-day credit spread. I think they're talking more about debit spreads or with buying calls, as Sam had mentioned in this scenario, doing the straddles that Sam does and closing them out as well. Okay. All right, Sam just says, in Tesla, my last 8 weeks, the bull put was at 0. Yeah, so you've done 8 weeks of bull puts and had them expire worthless. I did 1 in that. Okay, thank you, Chuck. Chuck agrees with me, and that's what he says. He says, Sosnoff from tastytrade, tastyworks, suggests grabbing 50%, but on a 40 to 50-day expiration. That's what I think it is. It's not in the shorter-term credit spreads because it wouldn't work with your trading plan, and I showed that in the Trade Simulator tool. Okay, we showed that in the Trade Simulator tool that cutting the gains down by half when you expect the full profit, you're still losing on the remaining one. So that's why I said I'm comparing apples to oranges, and according to Chuck and Sam, I am right. That's not what they're referring to. They're referring to the idea of those further out, maybe debit spreads or positions that you bought long calls, in which case it does make sense to close it at 50% profit so that you can still, you started off with maybe a 2-to-1 or 1-to-1 risk-reward ratio, so you still have it there as well. And, oh, Sam does, this is something I didn't know. Tasty guys don't do weeklies. I do weeklies, you know, but I do 2 weeks out in time. I don't trade anything I don't have any strategy I'm trading right now. Oh, that's kind of a lie. My bull puts are 2 weeks out, so I'm using weeklies, but I'm not doing the 4-day out, 5-day out trades in that case either. I don't do collar spreads with weekly options. I guess what you can say I do with weekly options is occasional straddles for earnings, so I'm using the shortest term expiration. I'm not planning on using a weekly for that. I'm just using the expiration that's closest to the earnings date. That comes after the earnings date, but is closest to the earnings date, following the ideas that Ernie's developing for the earnings straddles in that case. Okay, so that's just a comparison there, and believe me, even though that we're somewhat competitors of each other, don't get me wrong, I have extreme respect for everyone at tastytrade, with Tom and also their director of education. I think it was Mike. Mike and his whiteboard is very good at what he does. He's fantastic at what he does. So I would never say anything negative to them. But when we come to webinars and I'm in coaching sessions and I'm talking about credit spreads, or customers asking about credit spreads and asking about weeklies and say, well, I heard you should close the position at 50% profit. That's not what they're referring to. That should not be done on deep out of the money, high probability credit spreads that are shorter term. That's done, as Chuck and Sam helped me with here, for the 40 to 50-day trades that are out in time. Maybe those debit spreads that are more of the 2-to-1 or 1-to-1 risk-reward ratio should not be used on shorter-term credit spreads, in my opinion.